Greetings. I am compiling my TikToks from 2020 into one video, and my TikToks focus on business, money, and self-improvement. So hopefully these short TikTok videos will give you small nuggets of information that would be helpful for you. And although I have these TikToks as YouTube shorts on my YouTube channel, I think it's a good idea to put them in one place in one video, and I'll do it for all my TikToks for 2020 in this video, and I'll do another one for my TikToks from 2021 in another video. But I want to add that I am not doing this to promote TikTok, and I definitely do not want you guys to feel like you should sign up for TikTok if you don't have TikTok, because actually I think TikTok in general is not very good for you because it can be very addictive. The algorithm is designed to be addictive and to feed you things that catch your attention, and a lot of the content there is not helpful. It's not educational, to say the least. Honestly, a lot of the content there is a bad influence. So that is why I am not trying to promote TikTok, but I do make educational content there. So if you are on TikTok, you might as well learn something from it. So follow me on TikTok. But otherwise, don't sign up for TikTok if you're not on TikTok. The exception is if you're a creator, then it might help to take advantage of the high organic reach you can get from TikTok. But even then, I think long form content beats short form content, and TikTok videos are up to 1 minute long. It's based on short form attention grabbing content that keeps people's attention. Most of these are pretty meaningless or vapid. They don't really teach you a lot. They're not very meaningful most of the time. And even the ones that are meaningful will get outnumbered by the things that are a waste of your time. So I do make educational content on there. There are others who do so as well, but in general, you'll mostly get content that is not helpful for you. And that is to say the least, because some content can even be a bad influence for you. So anyway, that is my thoughts on TikTok. And yeah, don't sign up for it if you don't have it, unless you're a creator. Then it could be good for organic reach, but even then, I think with the content I'm making, the content I'm focusing on, I think long form content is much better in teaching people, and not just that, but it's better for training your attention span. And a focus on short form content that TikTok has reduces people's attention span. So I don't want a lot of people to sign up for TikTok, especially my viewers, because I want you guys to succeed in life, in business, in finances, in everything. And having a good attention span is important. And you don't want to weaken that by being drawn into a app focused on short form content, attention grabbing short form content that can reduce your attention span. So without further ado, let's get on to the video. What's a stock in 15 seconds? When you have a company, you can split the ownership of the company in a bunch of shares, which are also known as stocks, and you can buy and sell these in the stock market. What's a bond in 15 seconds? Bonds are a way for the government to raise money. When you buy a bond, the government gives you a bond, which is basically an IOU. They'll pay you at a certain date, but you can also buy and sell bonds from other people and trade them. What are REITs in 15 seconds? REITs stand for Real Estate Investment Trusts, which are real estate companies that own revenue-generating real estate. Its ownership is split into a bunch of shares, which are called REITs, and when you're buying these shares, you're buying REITs. What is private equity in 15 seconds? The ownership of a public company is split into shares called stocks. The ownership of a private company is split into shares called private equity. What is shorting stocks in 60 seconds? Shorting stocks or short selling stocks is a technique where first you borrow stocks from a lender and you expect the stock price to go down. So you're going to sell that stock to buyers and get money in return. Because you expect the stock price to go down, if all goes to plan, you will have to return it back to the lender. So first you would have to buy it back from sellers at a lower price if your theory is right, and then you can return the stocks back to the lender and you'll make a profit if the stocks you borrowed went down in price so that you can buy the stocks back at a cheaper price.
A challenge.
What's a market index in 60 seconds? A market index is a hypothetical portfolio of a segment of the financial market. For example, the Dow Jones is a hypothetical portfolio of 30 large companies in the US. The S&P 500 is a market index of 500 large US companies, and the Russell 2000 is a hypothetical portfolio of 2,000 small companies. And these market indexes are used to track the market and give people a good idea of how the market is going overall. But since it's only focused on a certain segment of the financial market, it gives investors and other people looking at the stock market an idea of a specific segment of the financial market and how that specific segment is doing overall. What's an index fund in 60 seconds? An index fund tracks a market index. I just made a video of what a market index is, so check that out. But to recap briefly, a market index is a hypothetical portfolio of a segment of the financial market. For example, the Dow Jones is a market index of 30 large US companies. The S&P 500 is a index of 500 large US companies, and the Russell 2000 is an index of 2,000 small companies. There are other examples of market indexes, but basically an index fund would track a particular index and its portfolio would hold the same stocks that the index has. So when you buy an index fund, you are basically buying a basket of stocks that make up a market index. What's an ETF in 60 seconds? ETF stands for Exchange Traded Fund, and it is a basket of stocks. How this basket of stocks is constructed depends on the particular ETF. Some ETFs track a particular market index. Other ETFs focus on a particular investment strategy, like value investing strategy or growth investing strategy. Other ETFs focus on specific markets, like the US domestic market or a developing market. So it depends on the particular ETF. But once you have a pool of stocks in the ETF, this pool of stocks can be pulled together and be constructed into a security. So you can split the ETF into different shares, and when you buy the ETF, you are buying a basket of these stocks. What's a commodity in 15 seconds? A commodity is a basic good that is interchangeable and not differentiable. Examples include gold, silver, oil, etc. For example, a bar of gold is the same as the next bar of gold. Three tips for building wealth for young people in 60 seconds. So if you're young, you probably don't have a lot of money to start off with unless you inherited a lot of wealth, in which case just skip the first tip. But my first tip is to focus on building your income or business first, because you won't make a lot of money from investing if you don't have a lot of money to invest. Let's say you invest $1,000 in the stock market and get the average annual return, which is 8%. That's $80 in a year. And you can make $80 in a day on minimum wage, so it's not really worth it. But once you have the money, my second tip is to use your money to make more money, because when you have a lot more money, let's say you have $1 million and get an 8% return a year, that's $80,000, which is more than what the average American makes in a year. But in order to have that money to invest, you need to practice delayed gratification, so you save your money and have money to invest. Why you should not consider a house as an asset in 60 seconds. By conventional accounting standards, a house is considered an asset, but I think it's better for people to not think of it as an asset, because it doesn't really put money in your pocket and it tends to take money out of your pocket. And when you think of assets and liabilities, a helpful way and practical way of thinking of it is that assets put money in your pocket and increase your income, while liabilities take money out of your pocket and increase your expenses. And because a house has so many expenses, such as mortgage payments and the interest payments for that, and utility bills, general upkeep costs, and maintenance costs, it really is a liability because it takes money out of your pocket, and it's not really putting money in your pocket. Yes, it can appreciate in theory, but it's not really putting cash in your pocket, and it is taking cash out of your pocket.
Okay, I get it. Let me think. I guess it's night.
Dura, 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 que está dura manda arriba porque tú te ves bien. Está dura, mamacita, te fuiste de nivel. Dura, mira cómo brilla tu piel. Está dura, dímelo cómo es que.
It's you, babe, and I'm a sucker for the way that you move, babe. And I could try to run, but it would be useless. You're to blame. Just when
I really gotta hold on.
standing ovation. Ooh, oh, yeah, 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 yeah. You look so dumb right now.
What are mergers and acquisitions in 15 seconds? Mergers and acquisitions involve the combination of companies. In the case of a merger, two companies will combine to form a new company. In the case of an acquisition, a company will take over another company. What is venture capital in 15 seconds? Let's say a startup wants to become a successful business. In order to do that, they need money, and this money is called venture capital, and that comes from investors like venture capitalists and angel investors. What's a derivative in 60 seconds? A derivative is a financial contract linked to the performance of an underlying asset or group of assets. And the thing about a derivative is you don't actually have to own the underlying asset or group of assets to form the contract. So for example, let's say we have party A and party B, and they sign a contract, which is the derivative. And the contract says if the gold price rises, A pays B. But if the gold price falls, B pays A. And this derivative is derived from the price of gold, which is the underlying asset. And neither A nor B actually have to own the gold to form the contract. You may be wondering, why would people form a contract like this? The reasons could vary. It could be as simple as making money, but generally it's to insure something you don't own because it could affect you in a different way. What's a credit default swap or CDS in 60 seconds? So let's say we have a lender who lends money to a borrower, but the lender is worried if the borrower can actually pay back the loan. So what the lender can do is get a credit default swap or CDS. And what a credit default swap is a financial contract that requires whoever is offering it to step in and pay back the loan in the case that the borrower defaults and fails to pay back the loan. And in exchange for this, the lender agrees to pay whoever is offering the CDS. More often than not, this is an ongoing payment and usually not a single payment. But in exchange, the lender gets an insurance policy in case the borrower defaults and fails to pay back the loan.
On myself, I'm blinded by the lights. No, I can't sleep until I feel your touch. I said,
What is an IPO in 60 seconds? IPO stands for Initial Public Offering, and you'll see why it's named that way very soon. So let's say we have a company and it wants to expand. In order to expand, it needs money, and it gets that from investors. So let's say the company starts off as small and privately owned, like all companies do, and it wants more money to become a bigger company and to expand. So what it can do is pick a public stock exchange or stock market and offer more shares to the public, which is why it's called a public offering. And since it's the first time it's doing this, it's called an initial public offering. So this public offering of more shares of the company to the public via the stock market is why it's called an IPO. And since now the company is bigger, there will be more shares held by more people, but the company is also bigger, and you can buy and sell these shares in the stock market.
What's that supposed to be about, baby? Girl, free up your eyes, stop acting crazy. Reminisce on all the good times daily. Try and pull the got me acting shady. What's that supposed to be about, baby? Girl, free up your eyes.
How corporations can legally pay less taxes through transfer pricing in 60 seconds. So first off, you need to know the definition of transfer pricing, which is the price that one branch in a company charges another branch for goods and services provided. So let's say we have company A, and A has a branch in the Cayman Islands and a branch in the US. In the Cayman Islands, just a side note, it has very friendly corporation laws, and the corporate tax rate is 0%. In the US, the corporate tax rate federally is 21%, but you also have to add state and local taxes. So let's say in the US it makes $100 million, and that gives you at least a $21 million tax liability. So in order to avoid the taxes, you can transfer that money to the Cayman Islands by charging that branch $100 million for branding. And so the profit you get is $100 million, and you pay 0% tax here because it's in the Cayman Islands. And the profit here is technically zero, so you pay no.
Feel the shot, body rock, rockin' don't stop. Round and round, up and down, around the clock. Monday, Tuesday, Wednesday, and Thursday, Friday, Saturday.
I can't wait to see the day when I could tell the ones who hate it I made it, that I made it, and they don't get involved.
The 6 types of business entities in 15 seconds. We have CNS corporations, LLCs, LPs, general partnerships, and sole proprietorships. I call these good entities because they provide asset protection and limit your liability, while these do not. What's a C corporation in 60 seconds? A C corporation is a type of business entity very popular with large companies. It is formed by filing in articles of incorporation, and it has a formal structure. The structure is that the company is divided into a bunch of shares, and the shares are held by shareholders. These shareholders own the company, and their ownership is based on how many shares they have. The shareholders elect a board of directors, and the board is responsible for overseeing the company. The board is also responsible for appointing officers like CEOs and CFOs, and the officers are responsible for running the company. Shareholders are not personally liable for the corporation, so if the corporation goes bankrupt and is in debt, the shareholders don't have to pay their personal assets to make up for the debt, and it is also governed by bylaws. What's an S corporation in 60 seconds? A S corporation is a business entity available for small corporations. It is very similar to a C corporation in that it's formed by an articles of incorporation filed with the government, and it has the same structure with a company and its ownership divided into a series of shares held by shareholders who elect a board of directors who oversee the company and appoint officers who run the company. And like C corporations, the shareholders are not personally liable, and it is also governed by bylaws agreed upon. So the added attributes to S corporations is that it has flow-through taxation, which means you can avoid double taxation by being taxed directly through the shareholders instead of being charged a corporate tax. It also is required to have 100 shareholders or less, and the shareholders must be citizens or residents. What's a limited liability company, or LLC, in 60 seconds? A LLC is a type of business entity formed by filing articles of organization with the state. Different states have different laws for LLCs, and different countries have different names for a similar type of business entity. Also, it's relatively new, so there is a lack of legal precedence for LLCs. That means that when you go into legal situations, you may not know what will happen because it simply hasn't happened before. So there are a few differences that distinguish LLCs from corporations. One is that it is able to avoid double taxation. So when corporations earn profits, it's charged a corporate tax, and if it wants to distribute the profits to shareholders through dividends, it's charged a dividend tax. So this is double taxation. However, for LLCs, when it earns profits, it can distribute it directly to members, and the members can be taxed individually. This is called flow-through taxation. Stick around for part 2. What's a limited liability company, or LLC, in 60 seconds, part 2. If you haven't seen part 1, check that out because this video is a continuation of that. Going off of where I left off, LLCs also have flexible allocation of profits and losses, unlike corporations. Let's say, as an example, a corporation is divided into 3 equal shares. The profits and losses must be distributed equally among all shareholders because they all own the same amount of stock, and that is the law. This is not the case for a LLC. Let's say, as an example, the ownership of the LLC is divided into 3 equal parts. The owners of the LLC, called members, can distribute profits and losses however they want. They all have the same voting power because they own the same amount of the company, but for whatever reason, they can decide to distribute profits and losses unequally. Stay tuned for part 3. What's a limited liability company, or LLC, in 60 seconds, part 3. If you haven't seen parts 1 and 2, check that out because this video is a continuation of those 2. So the last thing I want to talk about for LLCs is that it has a flexible management structure. So what do I mean by that? So for corporations, they have a formal structure that has to be adhered to legally. So they have shares that represent ownerships of the company, and it's held by shareholders who elect a board of directors who oversee the company, who elect officers who run the company. This is not the case for LLCs because it can be either member managed, which means all the members or owners of the LLC can manage it together, or manager managed, which means that members elect managers who could be members or could be non-members to manage it. So it's very flexible, and this gives it another benefit. What's a limited partnership, or LP, in 60 seconds? A limited partnership, or LP, is a type of business entity formed by filing a certificate of limited partnership with the government. There are two types of partners in a limited partnership. There are general partners who are personally liable for the company but have management authority, and there are limited partners who are not personally liable but have no management authority. Because being personally liable puts your personal assets at risk, a lot of people create another business entity like a corporation or LLC to become the general partner to fully protect their assets. So you may wonder, why would people form limited partnerships? It is very common to transfer wealth to the next generation, because that way the older generation can manage the assets while the younger generation can own them without managing them. Also, it's a way to avoid the inheritance tax, also known as the death tax. What's a general partnership in 15 seconds? A general partnership is an unregistered business entity with two or more partners. It's generally a bad idea because you'll be personally liable for business debts and lawsuits, and your personal assets will not be protected. What's a sole proprietorship in 15 seconds? A sole proprietorship is an unregistered business entity with one owner. It's generally not a good idea because you'll be personally liable for business debts and lawsuits, and your personal assets will not be protected. How to protect your assets and limit your personal liability in business in 15 seconds. If you want to not be personally responsible for business debts and obligations and protect yourself from lawsuits, then you have to set up one of these business entities and register that with the government. What is investment banking in 15 seconds? It's simpler than you think. It's basically to raise capital or money for businesses and organizations, and they do this by helping them go through IPOs or underwriting new debt or securities, or marketing their securities, or facilitating mergers and What is merchant banking in 15 seconds? Merchant banks basically help raise funds for corporations and high net worth individuals. They also do financial advising, and the US definition of merchant banking is more focused on international finance. What is private banking in 15 seconds? It's basically a bank for high net worth individuals. Most people go to a normal bank, they go to a private bank. They're more catered to. They have extra services like investing in portfolio management, wealth management, and help with wealth transfer. What's a trust fund in 60 seconds? A trust fund is a popular way to transfer wealth. There are three types of individuals involved with trust funds. There's the grantor, the trustee, and the beneficiary. The grantor puts in the money and assets into the trust fund, which can hold all types of assets like cash, stocks, real estate, businesses, gold, silver, etc. The trustee is responsible for managing the trust fund and growing the assets over time, usually through investment. Depending on the terms and conditions the grantor sets, the proceeds of the trust fund are distributed to the beneficiary. So there are two types of trust funds. There are revocable funds and irrevocable funds. For revocable trust funds, the grantor may change the terms and conditions, and he or she usually has more control. For irrevocable trust funds, it's very difficult for the terms and conditions to be changed. What's a hedge fund in 60 seconds? A hedge fund is formed when a group of investors pool their money to form a single investment fund. The hedge fund manager is usually one of these investors, and more often than not, he usually has a big chunk of money in the hedge fund, which gives him more credibility and makes the other investors trust him more because he has a bigger stake. So a hedge fund can invest in all types of different assets like stocks, real estate, private equity, commodities, etc. But most hedge funds have a specific investment strategy, and investors usually pick the hedge fund that fits their investment philosophy, or because they like the hedge fund manager and trust him. So hedge funds are usually only accessible to accredited investors who make large initial minimum investments. So all these investors are big investors, and that allows them to generate high returns and face less regulation that protects smaller investors. What's a mutual fund in 60 seconds? A mutual fund is a type of investment fund headed by a portfolio manager or money manager, and it invests in different types of assets like stocks, bonds, commodities, etc. It gets its funds from a lot of different investors who put the money into the mutual fund so that the manager can manage it for them and grow their wealth. And it's for small investors, so it's not like a hedge fund. And there's a lot of different investors putting small amounts of money together, and the manager pools the money and invests in different securities or assets. And it's much more regulated than hedge funds because the government wants to protect the small investors. So you can't do more risky activities that hedge funds do, which is why hedge funds, although they're more risky, can generate higher returns. But mutual funds are usually safer, but don't usually generate high returns. Should you invest in index funds, ETFs, or individual stocks in 60 seconds? When you buy an index fund, you're basically buying the stock market as a whole because it's a basket of stocks making up the stock market. So all you have to do is research the overall market, and there's almost no choice selection. You might want to buy the London Stock Exchange instead of the New York one, but besides that, it's very little. You either decide to invest or not. So I'd say it's the easiest to invest in. For ETFs, it's also a basket of stocks, but it's more specific, it's more narrowed down. It's based on different investment strategies and ETF specifics. So you do a bit more research, but it's still not a lot of research. So I'd say there's some choice selection and it's a medium difficulty. And for stocks, it's the hardest to invest in because you have to research individual companies in depth, and you also have to decide which companies to research. And since there's thousands of stocks in the stock market, there's a high choice selection, making it hard to pick stocks. So it's the hardest to invest in. What's a personal guarantee in 60 seconds? Let's say you own a business and you want to borrow money from a lender to expand the business. If your business is a registered business entity, it means that if your business isn't able to pay back the money to the lender, then you won't have to pay back the money with your own personal assets and your own money. However, the lender may ask you to sign a personal guarantee if your business doesn't have established credit. And what that means is that you agree that if your business fails to pay back the money, then you will pay back the lender with your own money and your own assets. What's the difference between investment banking and merchant banking in 60 seconds? Both investment banking and merchant banking involve the raising of capital or money for businesses and organizations. In terms of the differences, investment banking focuses on large corporations and organizations, while merchant banking focuses on small to medium-sized businesses and organizations. Also, investment banking specializes in IPOs and mergers and acquisitions, while merchant banking specializes in international finance.
You know, instead of waiting for a good day to happen, waiting around through ups and downs, I just said, look.
We're gonna have a good day, and all my homies wanna ride today, and all these
How to access TikTok if it gets banned in the US. Many of you have heard already that Trump says he will ban TikTok. We were hoping that Microsoft's possible acquisition of TikTok's US business would allow us to stay on the app. And it would have worked like this. So ByteDance, the Chinese company that owns TikTok and also owns Douyin, which is Chinese TikTok, will sell the US portion of its TikTok business to Microsoft. But a few hours ago, we learned that that might not actually happen. And since TikTok can still be accessed in other countries, the trick is to trick the system to think your phone is in a different region. In order to do this, you can download a VPN, which can give your phone a temporary IP address from another country. There are many VPN apps, but I have used ExpressVPN and NordVPN when I traveled in countries with internet restrictions, and they both work perfectly. So you can use a VPN if TikTok does get banned, but also follow me on YouTube and Instagram where I'll post similar content. Websites for making money online. You can make money doing freelance work on Fiverr and Freelancer. You can also do freelance work on Upwork, but also find long-term remote job opportunities, and same for Outsourcely. You can also get paid testing out new products that businesses put out on user testing, and try my UI. To make money tutoring people online, go to Wizant, Chegg, TutorMe.com, Tutor.com, and Tutors.com. Teaching non-native speakers English online is also another way to make money, and you can do so on 51talk.com and VIPKid. To sell gift cards for extra cash, go to Cardpool. And to make money with e-commerce or dropshipping, check out eBay, Amazon, Etsy, or Mercari. To make money with affiliate marketing, go to Amazon Associates, eBay Partners, Shopify Affiliate Program, or ClickBank. You can get paid writing articles on Medium, and you can make money making videos on YouTube if you join the YouTube Partner Program. What's the main difference between an ETF and an index fund? The main difference is that an index fund is a basket of stocks that tracks a section of the stock market, while a ETF is a basket of stocks or other assets that's based on an investment strategy. Can you make a TikTok in SBA funding? Yes, I can. SBA stands for Small Business Administration, and it's a part of the U.S. federal government. They have a loan program, and how it works is that if you're a small business operating in the U.S. and are a registered business entity, then you can get a loan from one of the lenders who partner up with the SBA. And how it works is that the small business would get the loan from the lender like it normally would, and if it can pay back the lender, that would be great. But usually when a business is starting out, the business doesn't have any established credit, so the lender would ask the business owner to sign a personal guarantee saying that he will pay back the loan personally if the small business cannot. But the SBA program would guarantee the loan for the owner so that the SBA will pay back the loan if the small business fails and cannot pay back. And that would protect your own personal assets and liability. What is fraudulent conveyance? In business, fraudulent conveyance is a way to avoid paying your assets to a creditor, and it is illegal, which is why it's called fraudulent. So how it works is that if you own a company and the company owes the creditor and you go bankrupt, then you have to pay your assets to the creditor to make up for the money you owe. And to avoid this, some people transfer their assets to another business entity they own, or another business entity they have control over, or a relative or friend has control over. And that way, all the assets go to the business entity and the company doesn't have to pay back the assets to the creditor, preserving the owner's control over the assets through the other business entity. The problem with this is that it is illegal, so if the creditor finds out and sues you, the court can declare the transfer null and void and take the assets and give it to the creditor. What are bearer shares? Let's say you have a company and the ownership of the company is divided into a bunch of shares. You have regular shares and you also have specific types of shares. One specific type is called bearer shares. So with regular shares, the owner of the share is usually listed and not anonymous. But with bearer shares, if you hold the certificate of the bearer share, then you own the bearer share. And it doesn't list who owns it, so you remain anonymous. So it protects the privacy of the owner, but there are several problems with this. Like I explained before on the video on fraudulent conveyances, if you owe something to a creditor and you can't pay back, he can take your assets, but if you have bearer shares, you can just send it to a trusted relative and friend and not pay back the creditor. Also, the IRS can't track if you transferred your bearer shares and charge you a gift tax, and they also can't track if you sold your bearer shares and charge you a capital gains tax, which is another reason why bearer shares are becoming illegal. What is money laundering? The definition of money laundering is the process of concealing the origins of money obtained illegally. And generally, there are three main steps to it. One is placement, and that means placing the money into the financial system. The second is layering, which is using financial transactions to conceal the origins of where the money came from. And the third is integration, which is integrating it back to the legitimate economy and using it for legitimate purposes. To give you an example, the gangster Al Capone made a lot of money bootlegging during the Prohibition era, which is the selling of illegal alcohol, because alcohol was illegal during that time. So this money was illegally obtained, and he money laundered it by putting it into his laundromat businesses, which were cash-intensive businesses, which is the placement part, adding it to the official books and records, which is the layering part, and then using it to buy his houses, mansions, cars, jewelry, which is his integration part. Corporation or LLC. So there's no one size fits all. It really depends on the specifics of your business and what you're looking for, but we can go over the differences. So for a C corporation, in my opinion, I think this is best for big businesses because there are unlimited number of shares and no limits on the types of stock or shareholders, and easy liquidity is really easy to buy and sell, but there are cons like double taxation and a fixed structure. S corporations and LLCs are better for small businesses. For S corporations, you have possible flow through tax treatment and straightforward liquidity, while LLCs, you have guaranteed flow through tax treatment and debt, and flexible allocation of profits and flexible management structure, which S corporations do not have. But for LLCs, you have less liquidity, and there's a lack of case law to predict legal situations, which doesn't affect S corporations. And there are other cons to S corporations. What is a charging order? So let's say this is your business, and for some reason you have a creditor that you owe money to. Maybe you got into a car crash and you owe him damages, or maybe you just owe him money for some other reason. So anyway, you have to pay him money, but what if you don't have enough money to pay for the damages? Then if you do not have a charging order, the creditor can reach and grab your business and take your ownership interest in the business and just take over the company. However, if a court grants you a charging order, which is available for LLCs and limited partnerships in most states and for corporations in some states, then instead of the creditor being able to reach and grab your ownership interest in your business, then you can instead allow the creditor to receive some of your distributions. But if you don't distribute your profits, then you don't have to pay him. The stocks billionaires are buying right now. If you've seen my previous videos, you know that you can go to dataroma.com to find the investment holdings and trading activities of billionaires and top investors, and they are required to release this information by law. Let's start with Warren Buffett, who has a net worth of $80 billion. This is what Warren Buffett is buying, and this is what Warren Buffett is selling in the past quarter. Let's move on to Bill Gates. The past quarter, Bill Gates really didn't do much. He basically just sold shares of Berkshire Hathaway, which is actually Warren Buffett's holding company. Let's move on to legendary investor Carl Icahn. The past quarter, this is what he's buying and this is what he's selling. Now let's look at renowned hedge fund manager Seth Klarman. Here's a lot more investment ideas for you to think about because he did a lot of trading the past quarter. Let's also look at another prominent hedge fund manager, David Tepper. Here's more investment ideas for you to look into.
I feel so close to you right now, and there's no stopping us right now.
If I were to start an investment fund or hedge fund, I would structure it in a way that most hedge funds structure it now, and I can show you how that works right now. Hedge funds themselves are usually structured as LPs or limited partnerships, and for limited partnerships, there are two types of partners. There's the general partner who has management authority but is personally liable, which is bad, because if you're personally liable, then if something happens to the business, then your personal assets are at risk. But with the limited partner, you have no management authority, but you are not personally liable, which is safe for you. So obviously, the hedge fund manager has to have management authority, which means he has to be the general partner. But how does he do that without being personally liable? The solution for this is for the hedge fund manager to create a LLC or limited liability company protecting his personal liability, and that LLC will become the general partner. What you need to know about the Tesla stock split. As most of you know, Tesla announced a 5-for-1 stock split on August 11th, and the new shares will be distributed after trading on August 28th, which is a Friday. So it will take effect on August 31st, which is a Monday. How this would work is that you have a Tesla share, and since Tesla has 186.36 million shares outstanding, each share would represent owning 0.5366% of the company. So when the share is split into 5 different shares, all these shares will amount to the same percentage ownership of the company. But even though you'll be owning effectively the same thing, since the Tesla share price is so high, many people can't afford to buy it. So when it is split, more people are able to buy it, which can beat up the price even more. Which is why after the stock split was announced, the share price went from $1,374 to $2,015.69. What you need to know about the Apple stock split. On July 30th, Apple announced that it will do a 4-for-1 stock split that will take into effect on August 31st. Because Apple's stock price is so high, the stock split will make Apple stock more accessible to smaller investors, allowing more people to buy Apple stock, which would beat up its price. That is why Apple stock has been soaring since the announcement. Its stock price jumped from about $385 to almost $500 right now. But since a stock split just means the original share is now 4 different shares, you still own the same percentage of the company as you owned before, so it really shouldn't matter. And even though the stock split will mean Apple stock will be more accessible to small investors, I think since the announcement, the stock price has gone so high that it more than makes up for the increased access to the stock. And that is why personally, I wouldn't buy Apple stock just because of the stock split. What's a benefit corporation? A traditional corporation's legal duty is to benefit its shareholders, and this is set in stone by the Michigan Supreme Court ruling of 1919, which says a business corporation is organized and carried on primarily for the profit of the stockholders. The powers of the directors are to be employed for that end. This ruling came from the Dodge v. Ford Motor Company case from 1919, where the Ford Motor Company was sued for not prioritizing the interests of the shareholders. So in 2010, Maryland was the first state to introduce the benefit corporation, or the B corporation. And unlike a regular corporation whose duty is just to its shareholders, the benefit corporation can consider the interests of shareholders, workers, employees, communities, environment, and the corporate purpose and mission. And now there are about 30-something states that also have legislation providing for benefit corporations. What's a professional corporation? If you're working as a doctor or engineer or lawyer or accountant or any licensed profession, then you can set up your own practice by establishing a professional corporation. You'll have to choose between one of these business entities and then set up a professional corporation as a subcategory. And this is a requirement in some states if you're working in a licensed profession, and when you set it up, you'll be required to show your licenses. And there are some benefits to it. You can protect yourself from the negligence or malpractice of your partners, but you cannot protect yourself against negligence or malpractice because that is a serious issue. And there are ownership restrictions such as only licensed practitioners can own the company or be shareholders, or the majority of shareholders have to be licensed practitioners. What is EBIT? EBIT stands for earnings before interest and taxes, and the formula to get it is you take net income and you add back interest and taxes to get the earnings before you deducted interest and taxes. What is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And the formula is to take net income and add back interest, taxes, depreciation, and amortization. What is EPS? EPS stands for earnings per share, and the formula to calculate it is to take the net income, subtract the preferred dividends, and divide it by the common shares outstanding, or how many common shares the company has. What's a PE ratio? The PE ratio stands for price to earnings ratio, and you get it by taking the share price and dividing it by the earnings per share, or EPS. What is ROIC? ROIC stands for return on invested capital, and you calculate it by taking the net operating profit after tax, or NOPAT, and dividing it by the invested capital, or the money investors put in. What's a DCF? DCF stands for discounted cash flow, and it is a valuation method used to find the value of a company, and you can compare that to the current share price. So it is based on the time value of money, which is the principle that $100 today is worth more than $100 next year because time has value. And it's a complicated formula to find the DCF value if you didn't go to business school, but basically you project the future cash flows, you discount it with the discount rate, which is based on the weighted average cost of capital, and you add them all up. And because you can't project all the years of the cash flow, you will have to add a terminal value at the end. So basically it's a lot of predictions, and it's not completely accurate. It's based on your predictions. But after that, you add assets, you subtract debt and liabilities to get the equity value, and then you can divide that by the shares outstanding to get the value of the share. What is growth investing? Growth investing is the strategy of investing in companies with strong growth potential, and that means strong expected future earnings and strong expected capital appreciation in the future. A good example of this would be Tesla. A few years ago, Tesla was losing money. It wasn't making profits, but investors were still putting money into Tesla. The reason is because they thought that Tesla will grow and it had good growth potential. And now Tesla is a bigger company. It has expanded and it's still expanding, and it is now profitable and making money. So generally speaking, growth investing usually focuses on tech companies and emerging markets, but overall, it just means investing in companies that you think will grow in the future and has a good future potential, even though it might not be making profits right now. What is value investing? Value investing is an investment strategy focused on buying undervalued stocks. Let's say we have a company and the share price is $50. If you do an investment analysis of the company, then let's say you figure out that the proper value of the share should be $100. Then you should buy the share because it is undervalued. And generally, if you're a value investor, if you think the share value is greater than the share price, then buy the share. So obviously, the share value or the intrinsic value is what you believe, and that's based on your own investment analysis, and you can do a DCF to figure that out. But it is subjective. It might not be the proper value, but it's based on your own rational analysis. And you can look at company fundamentals like price to book ratio, price to earnings ratio, free cash flow, and return on invested capital to figure out what the company is actually worth and buying it if the price is below the right value.
Yeah. For those of you that want to know what we're all about, it's like this, y'all. This is 10% luck, 20% skill, 15% concentrated power of will, 5%.
What is margin of safety? Margin of safety is a concept in investing used to minimize risk. Let's say we have a company and we are thinking of investing in the company. The share price, also known as the market value, is $50. And we do some investment analysis and we believe that the intrinsic value of a share of the company should be $80. So the margin of safety would simply be the intrinsic value minus the market value, which is 80 minus 50, which is $30. So this $30 is the difference between what we think the share should be worth and what the share price is right now. And the bigger the margin of safety, the safer it is to invest and the lower the risk. It can also be expressed as a percentage. So the margin of safety divided by the intrinsic value, which would be 37.5%. What's the difference between common stock and preferred stock? When people talk about buying stocks, what they usually mean is buying common stock, which is what all publicly traded companies issue. And they have all the characteristics we think about when we think about stocks, such as having voting rights and having a say in the company. However, there's a different type of stock called preferred stock, and it's not as common because not all companies issue them. And they are preferred in that they are paid dividends first before dividends are even considered for common stockholders, and they usually have regular dividend payments. Also, during a bankruptcy and liquidation, they are prioritized in that they are paid the assets first before it goes to the common stockholders. However, they don't have voting rights, although there are some exceptions, and because it's so stable, they don't have as much a potential for capital gain. So common stock is usually focused on getting company ownership, while preferred stock is more about getting a stream of income. What is market cap? Market cap is short for market capitalization, and it is the total dollar value of all the shares of the company. You get it by multiplying the share price by the shares outstanding. So it's basically the market value of the whole company. What is enterprise value? Enterprise value is a more comprehensive way of valuing a company, and what it represents is the amount of money it takes to acquire a company. So the formula for enterprise value is market cap plus total debt minus cash and cash equivalents. And this makes sense because market cap is the amount of money it takes to buy all the shares of the company. And you also need money to make up for the total debt the company has. However, if the company has cash and cash equivalents, you can subtract that because that will offset the price you pay to acquire the company. What's a stock option? A stock option is a financial product that gives the holder the right to buy or sell a stock at a certain price and during a certain time frame, or in some cases at a certain date. So there are two types of options. If you want to have an option of buying a stock at a certain price, then you get a call option. If you want to sell it at a certain price, you get a put option. What's a dividend? When a company makes money, that's called a profit, and it can distribute this profit to its owners or its shareholders, and this is called a dividend. What's a bull market? A bull market is used to describe a stock market where the stock prices in general are expected to rise. What's a bear market? A bear market describes a stock market where the stock prices in general are expected to fall. What are blue chip stocks? Blue chip stocks are stocks of companies that have excellent reputations and are well established and have operated for many years. They usually have large market caps and have dependable earnings. And some examples include Coca-Cola, Intel, Disney, McDonald's, and Johnson & Johnson. What are penny stocks? Penny stocks are stocks of small companies, and traditionally they're defined as trading for less than $1 per share, which is why they're called penny stocks. But now the official definition is that they're traded for less than $5 per share. And usually they're traded over the counter, and most often they're traded on the OTC bulletin board or the OTC markets group. What is over-the-counter trading? Let's say we have a big corporation. If it wants to raise money, it can go to investment banks and they can take the stocks of the big corporation to a formal stock exchange and sell it on that stock exchange where there are formal rules and also listing requirements. And not every company can meet these listing requirements or even want to trade according to these rules. So if we have a small company that maybe cannot meet these requirements or doesn't want to trade according to the rules, they can go to broker dealers instead, and they can take the stocks and sell them directly to investors. This is called over-the-counter trading, and the stocks being sold here are called unlisted stocks, while stocks sold on formal stock exchanges are called listed stocks. And there are networks of over-the-counter trading, such as the OTC Bulletin Board and the OTC Markets Group, which makes trading easier. What's a dividend yield? The formula for dividend yield is annual dividends per share over price per share, and it's used to give you an idea of how much dividends you'll get from a stock relative to the price you'll pay for that stock. The stocks billionaires are buying right now. For those of you who have seen my previous videos, you know I use dataroma.com to find the investments of billionaires and other top investors. Let's start with the most famous investor of them all, Warren Buffett. These are the stocks Warren Buffett is holding, and these are the stocks he traded last quarter. Now let's look at Carl Icahn. Carl Icahn is holding these stocks, and he only bought and sold a few stocks last quarter. On to the second richest man in the world, Bill Gates. Bill Gates invests through his charity foundation, and these are the stocks he holds. The past quarter, Bill Gates also bought and sold just a few stocks. Let's see what hedge fund manager David Tepper is up to. David Tepper owns these stocks, and he bought and sold a lot of stocks the past quarter, so that should give you a lot of investment ideas. Let's look at another hedge fund manager, Bill Ackman. These are his holdings, and here is his trading activity. Why your resume isn't getting seen when you apply to jobs online, and how to get your resume seen. So a lot of people send online job applications because it's the 21st century, and how companies usually handle this is they take the resumes from the job applications and run through a software that they usually just call the resume scanner. And how this works is that it scans your resume for keywords, and the resumes that match will be seen. So most of the time they make the keywords pretty stringent and precise, so only a few resumes match, and that's why most of your resumes will probably not be seen. So how do you boost your chances of getting your resume seen? Luckily, there's a website called jobscan.co, and it can give you the keywords and tailor your resume to match the job that you are applying for, which will boost your chances of getting your resume seen.
Do this right, let's do this right, let's go to this I feel like Friday nights. This I make you feel alive. I feel like we
Yes, I can explain it. Let's say you deposit or loan out a certain amount of money. The incentive to do that is that when you get your money back, you also get extra money, which is called interest. So the difference between compound interest and regular interest is regular interest, you will earn the same amount of interest as last time because the interest is just based on the original amount. Compound interest means that not only are you earning interest on the original amount, but you are also earning interest on the interest you got last time. So for example, let's say the interest rate is 20%. If you have $5, then the first round you'll get $1 of interest, but the second round for compound interest, not only will you get the extra dollar, but you will also get the 20 cents interest from the interest you got last time. And this is the formula for compound interest. Most likely there will be multiple time periods and multiple times the interest will be applied. What is a 10K? A 10K is a comprehensive report that every publicly traded company has to file with the SEC, and it's about its financial performance and other business data. And it would look something like this. What is a 10Q? A 10Q is a business report that every publicly traded company has to file with the SEC every quarter. It's basically a quarterly report. And this is what it would look like. Yes, I can explain how to find out the intrinsic value. So first off, you have to understand that intrinsic value is subjective because what we value is inherently subjective and it's based on our opinions. But it is important because our opinions form the price we are willing to pay and the price people are willing to pay so you can make money or lose money. So there are three major ways of evaluating intrinsic value. I won't have time in one TikTok to explain all of them, but the first and most popular one is doing a DCF or discounted cash flow. I did make a video on this earlier, so you can check that out. The second major way is doing a P/E ratio comparison. But when you do that, you should only compare the stocks of very similar companies like Coca-Cola and Pepsi. And the third way is just to take the assets of the company and subtract the liabilities, although this ignores the future prospects of the company.